Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our June monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right in. First of all, we hope to see many of you at our August quarterly investment forum a little bit later this quarter for scheduling reasons. So we hope to see many of you there. The invitation should go out very soon. A team member announcement. Congratulations to Nick for 3 years serving our amazing clients. Nick has also been busy. He was married last month and just got back from Hawaii. So congratulations, Nick. So we're going to reintroduce a concept that we talked about in honor of John Mark. We talked about this in our May monthly market update. So if you want to take a look at the first 2 minutes of that, but it's a different way of describing market conditions based on conversations that we used to have that describe things as either mirth or woe, mirth being the good stuff and woe being the bad stuff. So in honor of him, we're going to replace tailwinds and headwinds with mirth and woe as we kind of summarize key economic indicators and market conditions going forward. So there's a lot of that to consume. So let's get started. There continues to be this tension between earnings and fundamentals of the market and geopolitical risk. And so we'll unpack a lot of that, plus a little bit of things like inflation sentiment and the fact that Fed rate cuts seem to be on hold for now. So we'll start with earnings that were just out on Wednesday. The 14th largest market cap company, Micron, recorded just amazing news. EPS at 25, expected at 20, a revenue at 41.46 billion, over 300% increase from Q3 of last year. Margins up, so just an incredible number from the 14th largest and another over $1 trillion market cap company that was just posted on Wednesday. And Thursday morning, a lot of data, some good and some bad. PCE, which is the Fed's preferred inflation index, hit a 3-year high of annualized 4.1. However, on the good side, stronger than expected first quarter economic growth and a pretty healthy drop in jobless claims. So mixed bag with economic news on Thursday, June 25th. So as it relates to kind of where we have been in April and May, looking backwards just a little bit, the fifth best since 1950, 2-month period of time at up 16.3. Following a big fall in March after the war in Iran began. This is just a continuation of what we just talked about with Micron, which is just profits continue to surprise to the upside. Q1 2026, corporate profits 29% year over year. That's what happened in growth. Revenues were up by 12, and Q2 is expected, albeit a lower rate, but still 22% growth. So the one question that kind of surrounds all of these bullet points is, can revenues and profits continue at these levels? And what level of forward profits are built into current price? It's something we're following carefully. So as it relates to valuations, because earnings have been so strong, valuations are actually on a PE basis lower than they were at the beginning of the year, even though markets are up. And that kind of connects to, well, does this look a lot like the dot-com bubble that burst some 25 years ago? And while there are some similarities, there's a lot of differences as well. The most significant being that earnings growth and stock returns aren't as disparate as they were back when the dot-com bubble burst. As an example, 79% was the earnings growth of the tech bubble, but stock prices grew by almost 500%. In this case, you actually have the opposite. You have earnings growth that are higher than the stock returns. So what this shows at present, at least, is that the stock returns are justified with earnings, at least for now. Geopolitical risk overall is the other end of this tension between geopolitical risk and earnings is lower if many of the things that are proposed continue to hold. That means increased traffic in the strait, some version of the ceasefire, both temporarily and permanently hold, and that we're closer to the beginning or the end than the beginning. So overall, the markets are scoring a lower geopolitical risk at present, again, with some big ifs that these things hold. So what else are we following other than geopolitical risk and earnings? We're in an election year, so this looks at kind of where in this cycle stock market returns are, and they're typically lower than other years. However, the back half of the year is in a midterm year, which is what we're in, tends to be better with Q1 being or Q3 being flat, but the best quarter of a midterm year going back to 1926 is the fourth quarter. GDP, as we just mentioned, just surprised to the upside at a little bit over 2%. And as it relates to where we are in overall expansion, so we're currently in the 73rd month of the economic expansion, which compared to going back 100 years is a long expansion. If you compare that to expansion since 1982, the average expansion period is 104 months. So depending on what you're comparing to, this is either a long expansion or, again, going back to 1982, on average, we're at 73 on an average 104-month expansion. And where are we in the bull market? We're at 111% increase since October of 22, compared to an average bull market of 192% in 5.5 years. And this is where we sit in terms of length of time. So what this would say by historical standards on momentum and in time frame that we're not near the end of an average bull market. So we're still in a top-heavy market. The top 10 contributors to the S&P are responsible as of May 20th, so this is about a month old, 80% of year-to-date gains. So we're still in a concentrated top-heavy market. Another thing that's changed is the busy chart, but basically what it says is that the odds of a Fed cut have gone down dramatically. In fact, there's even increased odds of some Fed rate increase. So again, the market has swung dramatically because inflation is printing hot, like we mentioned earlier. So the likelihood of a Fed cutting rates multiple times is very low, and there's even some chance of a rate increase sometime this year. And that would put us in line with what a lot of other developed countries are doing, which is that they are raising rates, while at least at this chart would indicate that we're still in the mode of a probable rate cut sometime this year, but the chances of that are decreasing. So interestingly, sentiment is at an all-time low. And what this shows is with an even more recent read of 44.8 is on a kind of a contra-indicator basis when consumer sentiment is low, it tends to be good, which is this is the trough that we're in for 12-month returns in the S&P 500. As it relates to sentiment, one of the things to follow is this is soft data, so this is how you feel, to see if that's picked up in the future as it relates to hard data, such as spending. Money market assets sit at record highs at just under 8 trillion. What this shows is other periods of time where money market assets have peaked has typically been good for forward growth in stocks. Again, 172,000 was the May jobs ad, which was pretty good, and 93,000 revisions over the prior 2 months. So overall, a pretty good jobs number. As we mentioned before, a different measure of inflation at the beginning, but CPI, which is ex food and energy, sub 3, but so that is core, but CPI is at 4.2, which is the highest since 2023. So inflation spiking here. um, again, is connected to the fact that the Fed is less likely now to cut rates multiple times this year. So as it relates to kind of summarizing all of these things with, again, mirth and woe as kind of our tailwinds and headwinds description, kind of the what could go right in terms of what is supportive of markets continuing to increase. We've got oil prices falling due to lower geopolitical risk and inflation cools. A productivity boom based on AI and profit growth remains strong. So kind of the best bull case, the best mirth case is lower inflation and steady AI-driven demand. And the bear cases are higher interest rates, pressure stocks, the consumer weakens. So not only does the consumer feel bad, but that it shows up in actual spend and the AI spending starts to cool. So again, those are kind of the headwind, woe summary cases going forward. So all of this is no summary to contact us directly about how all of these things impact you. So please reach out if you have any questions about anything discussed here or anything going on in the economy and financial markets. We hope to see many of you again. August, you should receive this invitation very soon at our quarterly investment forum. And with that, we'll close. Thanking you again for the trust and confidence that you place in us. We look forward to seeing all of you soon in a Zoom call in office or at our quarterly investment forum in August. Until we see you again, be well and take care.